Hello dear students, welcome to the 8th session on the chapter Death of a Partner. In this chapter, that is Death of a Partner, I have covered most of the concepts except the last concept. The last remaining concept is about life policies, a very important concept of this chapter which is usually asked for 12 marks in the exam. In this session, I am going to cover that concept. Here we are going to discuss about meaning of life policies, the purpose of taking life policies by a partnership firm, different kinds of life policies which a firm can purchase, and finally regarding the recording of life policies in the books of partnership firm. So let us begin the session now. The concept of life policies, first let's understand the meaning of life insurance policy. It is not that only partnership firms can take up the life insurance policies, even individual like us can also take up the life insurance policies. So that is why let us understand the meaning of life policies and the purpose of taking up such life insurance policies from the point of view of individual. The life insurance policy is a contract between the policy holder and the insurance company, where the insurance company promises to pay certain sum of money in exchange for a premium either on the death of the policy holder or at the expiry of the policy period, whichever is earlier. Okay, so here taking up the life insurance policy protects ourselves from the risk that is involved with the life of the individual. Let us consider one case. There are two individuals, Mr. A and Mr. B. Mr. A, he has not taken up any life insurance policy, but Mr. B has taken up insurance policy and the sum assured in that case is rupees 10 lakh. Okay, at the expiry of that policy period or the death of Mr. B, the insurance company has to pay sum assured or the maturity amount which is rupees 10 lakh. Okay, so now let us suppose that tomorrow Mr. A dies. He has not taken up any life insurance policy, then his family members or his dependents would not get any amount from anybody because he has not taken up any insurance policy. Their life, the dependents of Mr. A's life, will be badly affected. On the other hand, consider the case of Mr. B. Tomorrow, if he dies, he has taken up the insurance policy amounting to rupees 10 lakh. Then the insurance company would pay the dependents of Mr. B amounting to rupees 10 lakh. Now, which is better? Taking up the life insurance policy is always better because it safeguards the interest of the dependents against the risk that may arise because of the death or the life risk of the individual. Similarly, even the partnership firm can also take up the life insurance policy, but the purpose of taking up the policy will be little different. In case of partnership firm, they take up the life insurance policy in order to safeguard the financial condition of the partnership firm in case of death of any one of the partners. Let us consider that there are three partners P, Q and R. One of them dies. Let us say P has died. So what happens now? At the time of death of P, the executor, that is legal representative of P, should be paid whatever the amount due to P. Okay, that may be his capital, whatever his share in the accumulated reserve, his share in the profit, his share in the goodwill, and etc. Okay, so whatever the amount due to P, that should be payable to the executor. Suppose if the partnership firm has not taken up any life insurance policy, then whatever the amount payable to the executor, that should be paid out of the working capital, the capital which is maintained for the day-to-day activities of the partnership firm. So if they take the money from that account, then their financial position will be badly affected. So in order to avoid that, the partnership firm can also take up the life insurance policy, so that in the case of death of any one of the partners, the insurance company would pay them the amount of the insurance policy, and the same amount can be used for paying the executor of the deceased partner. Okay, that is the main purpose of taking the life insurance policies in case of partnership firm. That is in order to safeguard the financial condition of the partnership firm in the case of death of any one of the partners. Okay, then let us understand the literal meaning of life insurance policies. But before that, let us also know what are the different kinds of life insurance policies which a firm can purchase. Usually it is divided into two types. The first one is individual policies, which are also called several policies. Okay, individual or several policies. And the second type is joint life policy. Let us understand the literal meaning of these two policies in the next slide. As I said, there are two types of policies, individual policy and joint life policy. On the death of a partner, the firm needs cash to pay the deceased partner's executor. As I said, in order to pay the deceased partner's executor, the firm may require the fund at the time of death of any one of the partners. If some arrangement is not made, then it may affect the financial position and working capital of the firm, because they will not have any other way other than taking the amount from the working capital. Okay, in order to arrange funds, it is advisable for the firm to take up the insurance policy on the life of the partners. Okay, so in order to safeguard the interest and safeguard the financial condition, they will have to take up the insurance policy on the life of the partners. Such policies may be in the form of joint life policy or individual life policies. Let us understand the meaning of joint life policy first. Joint life policy means, I gave the example of three partners. There are three partners, P, Q and R. Okay, so joint life policy is a single policy which is taken up on the joint lives of all the partners together. Okay, so they are taking up only one policy, one single policy on the joint lives of all the partners together. Okay, let us say they have taken up the policy for the same 10 lakh rupees. So now what is the condition for maturity of this policy? Either the death of any one of the partners, all the partners need not die because it is taken on the joint lives of the partners. Either the death of any one of the partners or the maturity period. Let us say the policy has been taken up for some 15 years. So the condition for maturity of this joint life policy would be either the death of any one of the partners or expiry of this 15 years, whichever is earlier. Okay, that is regarding the joint life policy. Then what is individual life policies? Individual life policies are those policies which are taken up separately on the life of each individual. Okay, here in this case we have three partners, P, Q and R. So they don't take up single policy, but they will take up life insurance policy on the life of each individual partner separately. In the name of P, they will take up first policy. In the name of Q, they will take up the second policy. In the name of R, they will take up the third policy. So it depends on the number of partners who are engaged in the firm. Okay. So the individual policies are separate policies which are taken up on the life of each individual partner. So they are also called several policies. Okay, the next point is that whenever they take up either joint life policy or individual life policy, they have to pay annual insurance premium to the insurance company. Now the question is, who has to pay that annual premium? So there are two options. Either the partners can pay that premium out of their personal funds, or the firm can pay that, treating it as an expense and debiting that to the profit and loss account. Usually we follow second method. The annual premium on the life policies which are taken up by the partnership firm, it is paid by the firm and it is taken as an expense, and that will be debited to the profit and loss account. As the firm is paying the annual premium to the insurance company, whatever the amount they get from the insurance company on the maturity of the life insurance policy, that becomes the asset of the firm. It does not go to one particular individual partner, but all the partners will have share in that. Okay, then taking up the life insurance policy always facilitate to settle the claim of the executor, because if they have not taken up the life insurance policy, then they will have to use the money which is kept for working capital. So whenever they take up the life insurance policy, that helps the firm to settle the claim of the executor, because the insurance company would pay them the maturity value. The deceased partner will also have share in the claim received from the insurance company, as well as the surrender values of the life of other partners. So this is regarding taking up individual policies. When the individual policies are taken up, let us say here I gave the example of having three partners in a firm, P, Q and R. So there are three partners and they will take up three individual policies, three several policies in the name of P, Q and R. Okay, now in case of individual policies, we have solved some questions on this concept. When it is an individual life policy, when one partner dies, then that particular policy will mature, because the condition is that either the death of concerned partner or the maturity period, whichever is earlier. So in this case I gave the example of P dying. Okay, so in that case, when P dies, the policy which was there in the name of P will be matured. Okay, but it does not mean that the entire amount will be given to P, because the annual premium to the insurance company has been paid by the firm. So that is why even other partners will also have share in that. Okay, that is the first point. Second point is that though these two policies are not maturing, we have to find out what is the surrender values of those policies on the date of death of P. Surrender value is nothing but if at all they surrender those policies to the insurance company, what is the amount they are going to get as on that particular date. So in that case, the deceased partner P will also have share in the surrender values of Q's policy and R's policy. That is how we show the adjustment with regard to individual life policies when it matures on the death of any one of the partners. Okay, the next concept is recording of joint life policy and individual life policy transactions in the books of the firm. Regarding individual life insurance policies, we have already solved 2-3 questions in the previous sessions. Please go through that, you will understand it. Okay, but coming to the joint life policy, there are 3 methods in which the joint life policy transactions can be recorded in the books of the firm. The first method is business expense method. Under this method, whatever the annual premium payable to the insurance company, that will be taken up as a business expense like any other expense, and that will be debited to the profit and loss account. On the date of maturity of the life insurance policy, whatever the amount they get from the insurance company, that will be credited to the partner's capital account in the profit sharing ratio. So that is regarding the first method. Then in the second method, that is maintaining joint life policy account at its surrender value. So here, after they take up the life insurance policy, they will have to maintain one account, that is joint life policy account. Whenever they pay the annual premium every year thereafter, so that will be considered as a partial payment towards an asset. Okay, then on the date of death of any one of the partners or expiry of the insurance period, so the policy will mature. So whatever the amount they get from the insurance company, that will be transferred to the joint life policy account, and the joint life policy account will be closed, and the whatever the final balance we get there, that will be transferred to partner's capital account in the profit sharing ratio. So that is regarding the second method. But as per the syllabus, we have to concentrate on the third method, and you will have questions on this third method, that is maintaining both joint life policy account and joint life policy reserve account at their surrender values. So let us first understand what is the meaning of surrender values. Just now I told you in the previous slide, surrender value is nothing but what is the amount the insurance company would pay them if they surrender the policy when they don't want to continue with the policy. Policy is not maturing, but the firm is surrendering the policy to the insurance company. At that time, what is the amount they would get? Okay, so that is called surrender value. So under this method, they are going to maintain 2 accounts. The first one is joint life policy account, and the second one is joint life policy reserve account. So when they maintain these 2 accounts, what are the transactions we have to record in the books of the firm? As I said in the second method, here also after they take up the life insurance policy, whatever the annual premium they pay thereafter, that will be considered as a partial payment towards an asset. They consider joint life policy as an asset. So that is why whatever the annual premium you pay thereafter, it should be considered as a partial payment towards an asset. Okay, so on that basis we are going to make the entries under third method. So let us consider the journal entries now. Before that, let me read the paragraph for you. Under this method, the premium paid on joint life policy every year is considered as a part payment towards an asset. Joint life policy account is maintained at its surrender value. Besides, a joint life policy reserve account is also maintained by setting aside every year out of the profits an amount equal to annual premium payable on the life insurance policy. Okay, so here what they do, they maintain 2 accounts, that is joint life policy account as well as joint life policy reserve account. Both the accounts will be maintained at its surrender value. Okay, so let's see what are the journal entries we have to pass when we maintain these 2 accounts. First set of entries have to be passed every year except the last year in which policy matures or death of a partner occurs. So let us understand these journal entries with an example. Let's say there are three partners A, B and C. They have taken up a joint life insurance policy. Joint life, on the joint life, all the partners together, they have taken up one single policy for a sum of rupees 50,000. So this is the sum issued by insurance company. The annual premium payable by the firm to the insurance company every year is rupees 3,000, and this policy is taken up for 10 years period. The date of payment of first premium, nothing but date of taking up the life insurance policy, is on 1st January 2015. And let's say partner A has died on this particular date, that is 31st March 2019. So this is the given condition. Based on this, let us analyze the journal entries. It is given that the first set of entries have to be passed every year except the last year in which policy matures or the date of death of partner occurs. So policy has been taken up on this particular date, that is on 1st January 2015. So there is time for 10 years to get the maturity value. But before that, in the year 2019, one of the partners, that is A, has died. So because of death of A, the policy matures on this particular date. They need not wait till the completion of 10 years. So at the end of 5th year itself, not at the end, in the month of March of the 5th year, they are going to get the maturity value of the insurance policy. Okay, so now first set of entries have to be passed in the every year except the last year in which policy matures. So for 2015, 2016, 2017, 2018, we have to pass first set of entries. In the year 2019, that is the last year in which policy has matured because of death of A, so we are not going to pass first set of entries. So we are going to pass first set of entries only in the year 2015, 2016, 2017 and 2018. Okay, so what are the entries we have to pass here? As we just now discussed, we are going to maintain two accounts. The first one is joint life policy account and the second one is joint life policy reserve account. So here the first entry will be passed on the date of payment of premium. The entry is joint life policy account data to bank account. Here the joint life policy account is debited because it is treated as an asset. Okay, we are going to debit that joint life policy account data to bank account. You are making the annual premium payment, so you have to credit the bank account. Then this next entry will be passed at the end of every year for setting aside out of the profit an amount equal to the annual premium payable on the policy as the joint life policy reserve. So whatever the annual premium you have to pay every year, to that extent you are making the appropriation of profit. From the profit and loss account, you are keeping aside that amount as a joint life policy reserve account. In this example, what is the annual premium you have to pay? It is 3,000 rupees. So at the end of each year till 2019, that is 2015, 16, 17 and 18, at the end of those years you have to keep aside rupees 3,000 annual premium as a appropriation of profit. That is, you are transferring the amount from profit and loss account to the joint life policy reserve account. For that, what is the entry we are going to pass? Profit and loss account data to joint life policy reserve account. So here we are creating one reserve, so it must show a credit balance. That is why we have credited here, and we are making the appropriation of the profit. That is why profit and loss account is debited. Then the third entry has to be passed for reducing the value of joint life policy and joint life policy reserve account at their surrender values. Okay, so here, as I said, we are going to prepare two accounts. The first one is joint life policy account and the other one is joint life policy reserve account. Okay, so this is joint life policy account and this is other one is joint life policy reserve account. Okay, along with these informations, they will also give you what is the surrender value at the end of each year. For 2015, let's say the surrender value is rupees 500. At the end of second year, that is 2016, the surrender value is 750. Then it is 1000, 1200, etc. Okay, we are concerned about the surrender values at the initial years. So the third entry says that we have to reduce the amount which is there in the joint life policy account as well as joint life policy reserve account at its surrender value. But before that, we have passed two entries. The first entry for making the payment of premium. What is the entry we have done here? Joint life policy account data to bank account. So in the joint life policy account, we are going to write to bank account. What is the annual premium you are going to pay? Amount is 3000. Okay, so here the second entry will be passed for keeping aside at the end of the year an amount equal to annual premium. What is the entry we need to pass here? Profit and loss account data to joint life policy reserve account. So in the joint life policy reserve account, we have to write by profit and loss account. What is the amount you have to write here? 3000. So before passing the third entry, we see that there is 3000 amount in both the accounts, but it is said that by passing the third entry, we have to reduce these amount to the surrender value. What is the surrender value we have here? At the end of 2015, the surrender value is only 500, but we find that there is 3000. So what we have to do? We have to cancel the excess amount. What is the excess amount we have here? 3000 minus 500. 2500 is the excess amount. So in order to cancel that, we are going to pass the next entry, that is joint life policy reserve account data to joint life policy account. In the joint life policy account, this amount is showing a debit balance. In order to cancel 2500, you have to give credit to the joint life policy account. Similarly, in the joint life policy reserve account, we have credit balance of rupees 3000. In order to cancel the excess of 2500, we have to give debit to the joint life policy reserve account. So you are going to make the entry joint life policy reserve account data to joint life policy account. So here you will make the entry by joint life policy reserve account to the extent of 2500. The other part of the entry will be recorded here to joint life policy account 2500. Okay, after making all these three entries, you are going to close the account for that year and find out what is the balance remaining. So here it is 3000, here also it is 3000, remaining balance is rupees 500. So here also it is 3000, here also it is 3000, the remaining balance is rupees 500. Okay, so these are the closing balances which we have in joint life policy account and joint life policy reserve account. So it will be written as by balance carried down and to balance carried down. So these are the surrender values at the end of first year. Okay, as we considered here, so this is the surrender value. That is why both the accounts are reduced to the extent of surrender value at the end of that particular year. So that is regarding the journal entries which we have to pass in the first set. First entry will be passed on the date of payment of premium, that is joint life policy account data to bank account. The second entry will be passed at the end of every year to make appropriation of profit by passing the entry profit and loss account data to joint life policy reserve account. And in the third entry, we are going to reduce both the accounts, that is joint life policy account as well as joint life policy reserve account at their surrender value by cancelling the excess amount which we find in those two accounts. Okay, so this is regarding the first set of entries. Second set of journal entries have to be passed in the last year, that is the year in which policy matures or death of a partner occurs. So in the present example which we have considered, one of the partners A died on 31st March 2019. The policy period started in the year 2015, but he died in the year 2019, because of which they need not wait till the completion of 10th year. So policy matures in the year 2019. Okay, because of death of one of the partners. In the year 2019, that is considered as the last year in which the policy matures because of death of one of the partners. So what are the entries we need to pass in that year? The first entry will be passed on the date of payment of premium. The entry is similar to the previous set of entries, joint life policy account data to bank account. But you have to make sure that the partner died after making the payment of premium. Okay, so if he dies before making the payment of premium, then this entry does not come. Okay, this entry will be passed only if the partner dies after making the payment of annual premium. Okay, then the next entry is on the date of receipt of policy amount. So insurance company would pay them the policy amount amounting to rupees 50,000 on that date. What is the entry we are going to pass? For receiving the policy amount from the insurance company, we are going to pass the entry bank account data to joint life policy account. But before that, you have to also have some other entries. Let us pass the entry for 2019. As you know that these two accounts are maintained at their surrender values. Here I have written the surrender values. This is the surrender value for the year 2015. This is for 2016, 2017 and 2018. So the closure of 2018 is nothing but the beginning of 2019. In the year 2018, at the end, they have maintained both joint life policy and joint life policy reserve account to the extent of surrender value. How much is it? 1200. So the same amount will be brought forward at the beginning of 2019. So on 1/1/2019, so you will write to balance brought down amounting to 1200. Okay, similarly in the joint life policy reserve account also, on the credit side we will bring down the balance by balance brought down 1200. Okay, then he died on 31st March 2019, but you have to make the annual payment of premium on 1st January 2019 itself. So you will make the entry joint life policy account data to bank account. The amount is 3000. Okay, then on 31st March 2019 he died. So because of which the insurance company would pay them amount which is 50,000. Policy amount is 50,000. So what is the entry we need to pass here? Bank account data to joint life policy account. So we will make the entry on the credit side by bank account 50,000. By bank account 50,000. Okay. Then the next entry will be for the transfer of final balance in the joint life policy reserve account to the joint life policy account. If you see the joint life policy reserve account, here we have 1200, which is the surrender value of the previous year. So the same amount will be transferred to the joint life policy account. 1200 will be transferred to the joint life policy account. Final balance in the joint life policy reserve account will be transferred to joint life policy account. So here you have passed the entry joint life policy reserve account data to joint life policy account. So in the joint life policy account we are going to write by joint life policy reserve account amounting to 1200. Okay, then the last entry we have to pass for transferring the ultimate balance in the joint life policy account to the capital accounts of all the partners, including the deceased partner, in the profit sharing ratio, which means that after writing all these entries we are going to close the joint life policy account and find out what is the final balance we get on the debit side, which is the balancing figure, and that will be transferred to all partners capital account in their profit sharing ratio, and the entry would be joint life policy account data to all partners capital account. Okay, so that is how we are going to pass the entries in case of joint life policy for recording the joint life policy transactions. Okay, so this is regarding the journal entries for recording the joint life policy transactions in the books of partnership firm. Before I wind up this session, let us once again summarize what are the journal entries you have to pass. For recording the joint life policy transactions, we are following the third method, that is maintaining the joint life policy as well as joint life policy reserve account at their surrender values. Okay, so for that we are going to pass the journal entries in two sets. In the first set we pass the entry at every year except the last year in which policy matures either because of expiry of the maturity period or death of any one of the partners, whichever is earlier. Okay, so on the date of payment of premium we pass the first entry, that is joint life policy account data to bank account. Then other two entries have to be passed at the end of every year except the last year. So in that the second entry will be for making the appropriation of profit. The entry is profit and loss account data to joint life policy reserve account. Then the third entry will be for reducing the joint life policy account as well as joint life policy reserve account at their surrender values. So this is the first set of entries, and the second set of entries will be passed in the last year in which the policy matures either because of the expiry of the maturity period or the death of any one of the partners. Okay, whichever is earlier. So here we are going to pass three entries. The first entry will be passed on the date of payment of premium. The entry is joint life policy account data to bank account. The second entry will be on the date of receipt of policy amount from the insurance company. The entry is bank account data to joint life policy account. And the third entry will be for transferring the final balance left in the joint life policy reserve account to the joint life policy account. The entries joint life policy reserve account data to joint life policy account, and the last entry will be for transferring the final balance we have in the joint life policy account to the partners account. The entries joint life policy account data to all partners capital account. We are going to practice these journal entries while preparing the joint life policy and joint life policy reserve account in the next videos. So I'm going to solve few questions on this concept. So let us meet up in the upcoming video. Thank you for watching.